Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Wednesday afternoon, we have Ryan McCormack, actor and core equity strategist at Invesco, to discuss Nasdaq 100 weekly performance and, of course, touch on the whole growth versus value story. Ryan, it's great to see you as always. Let's pull up your first chart and talk about weekly performance, because a lot has changed since the last Wednesday you and I spoke.
Yeah, that's for sure. Probably the understatement so far of 2021. An absolutely unprecedented week, right? A word that we're using far too often here over the last 12 months. But when the dust settled, you kind of look at your performance, and you have QQQ up 70 basis points relative to the S&P 500 up 2.02%, versus the S&P 500 value up 3.61%, versus the S&P 400, which is mid caps, up 6.35%. versus the S&P 600, your small caps, of 7.48%. So what we're seeing here is this continued recovery or reopen trade, right? Traditionally, when you're looking early cycle, in the recovery stage of the economic cycle, you traditionally are seeing value along with small size from a factor perspective outperform. So that progression right there went from essentially large growth all the way down to small caps. And you can see with each step or each index that I covered, you saw more and more performance as you went down in market cap, right? Sort of typical when you're looking at smaller size companies outperforming in the early stages of an economic recovery. Now, this recovery we've been talking about for months here, and it's been fits and starts. But I think when you look at last week's performance, it's really driven by stimulus. Now, you go back to October, and you and I spoke, and we saw investors positioning for this blue wave ahead of the election. And after the Georgia runoff election last week, and Democrats controlling Congress as well as the White House, what that paves the way for is further fiscal stimulus, which Biden said could reach into the trillions. By tomorrow, he's set to unveil his fiscal support for that package. But with that, you're looking at economic growth being propped up by this fiscal stimulus, and we see that reopen or sort of early recovery trade and these smaller size and value driven stocks outperforming. I think when you look at the reasoning for some of this additional fiscal support, the employment picture is a perfect example as to why we need this further stimulus. We saw a surprise 140,000 decline when you looked at the December non-farm payrolls report. That was the first decline that we've seen since April of 2020, where we saw unprecedented payroll decline of over 20 million. Beyond that, as you look at some of the initial jobless claims reports in December, we eclipsed that 800,000 mark on a weekly basis, the first time that we saw that since October. So, with that, I think you look at the employment picture and that need for stimulus, the fact that now Democrats control Congress, they control the White House coming up here, that paves the path for this further stimulus. And that's really what's fueled this small size and value rally that we've seen here over the last week.
Yeah, those are all excellent points, Ryan. Let's wrap up with your final chart here when we drill it down to sector performance.
Yeah, so the sector performance chart just kind of further emphasizes the story. When you look at energy, up nearly 10% for the week, financials up over 7%, materials up nearly 6%, industrials up nearly 4%. Again, your cyclically oriented, more value-driven sectors sort of leading the way over the course of this week. A lot of it, of course, hinges on the stimulus. Beyond that, it's putting COVID-19 in the rear view, right? So, we have these two vaccines that are authorized under FDA emergency use. We have a few more in the hopper. And with it, it's going to be we're going to need this effective vaccine distribution to put COVID-19 in the rear view. And as we head into the always entertaining earnings season, I think people will continue to look at company transcripts for what impact COVID-19 has had on their business. So far, they've looked pretty good. Earnings reports largely have surprised to the upside. You're hearing some commentary that maybe estimates for Q4 came down too much. And as you look at the S&P 500 and other popular indices, including the Nasdaq-100 with elevated PEs. You almost wonder if it's time for the E portion of PE to start to catch up. So, seeing that that earnings growth catching up with some of the price, and all of this elevated valuation, pretty consistent with early stage recovery. So, we'll take it 1 week at a time. But I think as you look at fiscal stimulus and hopefully very solid vaccine distribution, putting this in the rear view, we are setting the stage for economic recovery.
That would be a great way to move through 2021, considering what last year was like. Ryan, great to see you as always. Thanks for joining us, Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.